Hi, I'm Laurence Parker-Brown. Welcome to the Inside Network. Welcome to this INDepth for the Inside Network. Joining us today to explore the role of first-ranking mortgages in income-generating portfolios is Jonathon Pullin, partner and head of real estate credit at Barwon Investment Partners. Welcome, Jonathon.
Good to be here.
Could you tell us a little bit about Barwon Investment Partners?
Sure. So Barwon Investment Partners is an independently owned funds management firm. We're based in Sydney, Australia. We've been in operation since 2006, and we manage just over $3.1 billion of capital on behalf of institutional investors primarily, and second to that, wealth management groups and financial advisors across the country.
Could you tell us a little about the Barwon First Mortgage Fund?
Sure. So the Barwon First Mortgage Fund is a open-ended fund available to wholesale investors. The fund itself invests in a portfolio of first-ranking mortgage loans that are secured over property located here in Australia. The returns on the fund, net of fees and costs, currently sit at just north of 9% per annum, and the fund itself provides investors with regular income distributions on a monthly basis.
So let's look at the structural changes. A lot's happened in the last few years, and it's seen considerable growth in that non-bank lending. That means there's a lot of choice for advised clients, a lot of breadth of options. How should an advisor think about this new terrain?
Yes, well, sure. The size of the market has increased significantly over the last few years. If you look at the last 4 years alone, the size of the non-bank credit market in Australia has nearly doubled in size. That now represents near on to 16% of the real estate credit market here in Australia, with obviously the balance being made up by major bank lenders. What does this mean for investors? Well, their range of options in regard to non-bank investments is much, much larger than what it used to be 5 years ago.
Now, for capital that's reticent to take on risk, you've got this spectrum of opportunity. You've got before, during, and after construction. How can capital that's really careful start to think about the opportunity set?
What we do is very, very simply, we look at a property and put it into a very, very simple life cycle. We break it into three parts. We talk about the pre-construction stage, which is obviously when the land is bought. Then it goes through a journey of approvals, pre-leases, pre-sales, whatever it may be. The project then moves into its next stage, which is the construction stage, which is obviously the construction of whatever it's to be developed ultimately into. And then we have the third and final stage, which we call the post-construction stage, which is when the property itself is fully developed. There's no construction risk anymore. And then it's either sold down into the market or it may be retained and leased up to produce income. By looking at property in these three distinct stages, what we can do is then isolate the risks for each of these three stages and assess them individually. So what we find in the current market is that middle stage, that construction stage for us represents what we believe to be a very high level of risk. So what we do in our team is tend to focus on the other two stages, the pre-construction and the post-construction stage. The reason we do that is we believe the returns available for those two investments, those two styles of investments, offer a better return reflective of the significantly lower risk they have in comparison to the construction stage.
That makes perfect sense. So you've got all of this choice. There's so many market participants. There's choice across geography, type of assets, and this phase of construction. How do you at Barwon Investment Partners, Jonathon, start to think about due diligence?
Yes, well, what we do is it's what we internally call a borrower-led approach to our due diligence. What that means is that we first and foremost review the borrower of a potential loan before we get into the property. So in terms of our review of the borrower, what are we looking for there? We're looking for obviously deep experience in whatever is the enterprise they're undertaking, experience in similar kinds of developments or similar types of property ownership in the past. We're looking for a depth of expertise within their teams. We're looking at what the borrowers like to deal with when we're sitting across the table from them. And very importantly as well, we're looking for a certain level of financial alignment from the borrower in whatever the venture is they're undertaking. Why do we do that? Why do we lead with that borrower review first? Because we've done many of these loans in the past. We've done hundreds of these loans over many, many years. And what we've found is by making sure that our borrower is at a certain level, in terms of all of those measures that we had previously, that can provide a layer of credit enhancement to a lot of the investments we make. We find that the borrower is often quite instrumental in getting the loan to completion and repaying it successfully over the term. So that borrower-led style of review is a key point of difference to our investment team at Barwon compared to a lot of other non-bank lenders in the market.
And as a fund manager, you're looking for diversification, you're looking for that due diligence. And how else are you starting to think about that concentration risk if you're working with similar entities around?
Yes. Well, firstly, like with any concentration risk, the best thing you can do is obviously construct a portfolio where each underlying investment obviously is small in size relative to the overall size of the portfolio or the fund itself. So we have sensible limits in our funds in terms of the size of each individual loan that can be in there. In addition to that, what we do as a team is we look across the whole of country in terms of the investments we make. So we've got good geographic diversification across the portfolio. And in addition to that, we're able to generate very good sector diversification. So we'll have loans in the portfolio at any one time that will range from residential apartments, residential townhouses, all the way through to commercial office, all the way through to even completed and trading hotels. So that sector diversification is very important in the portfolio. You put all of those things together, we then generate a very, very good and sensible diversification of the whole of portfolio. So if we were to have an issue with a particular loan in the portfolio, it would have a very, very small impact on the wider performance of the portfolio at any one time.
So for many advisors, they're working with clients that have that challenge of higher cost of living. They're trying to generate resilient income for retirees for many, many years. You've got the compelling story of, an asset class that's done very well in Australia, investment level of due diligence that's institutional. How do you think about what sort of role this can play in a portfolio? Where does it sit, Jonathon? And as an advisor trying to bring this to clients, what can you expect it to produce?
In terms of these first mortgage loans and the benefits of them, obviously the underlying loans themselves within the fund or the portfolio, they're a loan to a borrower. So the borrower repays that loan. And that repayment is treated as an income repayment. So that income is then flowed through as distributions to investors. So you don't have any capital movement in the portfolio, it's all income return. And in addition to that, because we're setting up obviously a loan facility with preset repayments on that loan facility, that generates regular income that then comes through to investors. Combine that then in a portfolio, and then you have very sensible, regular and frequent distributions of cash through to investors. So what we encourage a lot of advisors who are looking for this kind of first mortgage investment in their portfolio is to complement it with other types of investments where they're getting capital return and that kind of thing, so they can blend both the income and capital return into their portfolio for their investors.
Thank you so much for your time today, Jonathon.
No problem.